Hey everyone, and welcome to The Explainer. Today, we're diving into something we use every single day but almost never think about: money and credit. I mean, this stuff is basically the engine that runs our entire world, but how does it actually work? So let's kick things off with a pretty basic question. I mean, have you ever really stopped to wonder why a simple piece of paper or, just some numbers on a screen can get you lunch or a new phone or even a house? When you really think about it, it's kind of strange, isn't it? The answer to that question, well, it tells this incredible story about trust, society, and the very foundation of our economy. Okay, so here's what we've got on tap for this explainer. We're going to start with the move from barter to banks, then look at the two very different sides of credit. After that, we'll get into formal versus informal credit, dig into the collateral problem, and wrap up by exploring some new ways people can get access to credit.
All right, let's jump right in with Section 1, from barter to banks. To really get a grip on money, we got to go way back to the beginning and understand the simple but world-changing idea that it's solved.
So I want you to imagine a world without any money, okay? Let's say you're a shoemaker and you make amazing shoes, but you're hungry. You need some wheat. You go find a farmer who has tons of wheat, but here's the problem. She needs clothes, not shoes. So, no deal. No trade happens. You both have something valuable, but it's not valuable to each other right then and there.
This massive problem with a barter system actually has a name. It's called the double coincidence of wants. It's a bit of a mouthful, but all it means is that for any trade to happen, you have to find someone who has exactly what you want, and they have to want exactly what you have. You can probably guess, this is a super inefficient way to run, well, anything.
So, to get around this whole problem, humanity came up with the brilliant idea of money, and it's evolved a lot over the years. Way back, people used things that had their own built-in value, like grain or cattle. Then we moved on to metallic coins, gold, silver, copper, because they were way more durable and easier to lug around. And that whole journey eventually led us to what we use today: paper notes and coins.
But here's the really wild thing about the money we use today. That banknote in your wallet, it isn't made of anything precious. It has no real use on its own. So why on earth do we all accept it as payment? Well, it's actually pretty simple. We accept it because the government says we have to. In India, for instance, it's the Reserve Bank of India that authorizes it, and the law says it must be accepted for payments. It only works because we all, as a society, believe in that promise. And this is where banks come into the picture and become so important. So you and I, we deposit our extra cash in a bank to keep it safe, right? Now, the bank doesn't just let it sit there. They have to keep a small chunk on hand for when we need to make withdrawals. In India, it's about 15%. But the rest of it, they loan it out to other people and businesses that need cash. And that's how they make their money, from the interest they charge on those loans.
Okay, so banks make money available by giving out loans. And that brings us to our next big topic: credit. But credit, well, it has two very different faces. The question is it a ladder that helps you climb up, or is it a pit that you can fall right into? To see what I mean, let's look at two totally different stories. First up, we have Salim, a shoe manufacturer. He gets a huge order right before a big festival. To get it done, he takes out a loan for leather and to hire more workers. It's a pretty low-risk bet. He makes the shoes, delivers the order, makes a nice profit, and pays back the loan. No problem. For Salim, credit was a total game changer, a ladder to success. But now let's look at Swapna. She's a small farmer, and she takes out a loan to pay for seeds and fertilizer. But then, disaster strikes. Her crops get hit by pests, and the whole harvest fails. Suddenly, she can't repay her loan, and that debt just starts to spiral. For her, credit turned into a devastating debt trap.
So what's the lesson from these two stories? It's that credit, by itself, is just a tool. It's not inherently good or bad. Whether it ends up helping you or hurting you really boils down to two things: how much risk is involved in your situation, and, this is the big one, whether you have any kind of safety net if things go south.
And a huge part of that risk comes down to where you get the loan. This brings us to a really important point: the difference between formal and informal credit. And believe me, who you borrow from matters a lot. Just take a look at this chart showing where people in rural India get their credit. It's pretty eye-opening. You can see that the formal guys, the banks and cooperative societies, they make up about half of all the loans. But look at that biggest slice of the pie. A full 1/3 of loans come from informal moneylenders, and then you have another chunk from relatives and friends. It shows this massive dependency on sources that are completely outside the official regulated system.
And if you think that's something, check out this next chart. It shows a huge divide in who actually gets to use formal credit. For poor households in cities, a staggering 85% of their loans come from these informal sources. Now flip that and look at rich households. For them, 90% of their credit comes from formal sources like banks. That is a massive, massive gap. So why? What's going on here?
Well, the biggest reason for that gap brings us to our next section, the collateral problem. This is hands down the single biggest hurdle that stops people, especially the poor, from getting a loan from a bank. So what exactly is collateral? Well, simply put, it's an asset, something valuable that the borrower owns. It could be land, a house, a car, even savings in the bank. You use this asset as a guarantee to the lender. The deal is, if you don't pay back the loan, the lender has the legal right to sell your collateral to get their money back. It's their safety net.
And this creates a really tough trade-off for a lot of people. On the one hand, you have formal bank loans. They have lower interest rates and they're regulated by organizations like the RBI, which is great. But they demand all this paperwork and, of course, collateral. On the other hand, you have informal lenders. They might not ask for collateral, which seems easier, but the price you pay is insane. We're talking about incredibly high interest rates, sometimes 60% a year or even more. And there's no one supervising them, so they can use really unfair tactics to get their money back.
So if not having collateral is the main roadblock, what's the way around it? Well, that's what we're looking at in our final section. Some really clever new paths to credit that have been designed specifically to help the poor.
Okay, one of the most powerful ideas to come out of this is something called a self-help group, or an SHG. Here's how it works. You get a small group together, usually 15 to 20 neighbors, and very often it's women who lead these. They all start pooling their small savings together, little by little. Then, members can take out small loans right from the group's own savings pot. Now here's the magic part. If the group proves to be regular and reliable with their savings and repayments, they then become eligible for a loan from an actual bank. The group's collective savings and trust become the guarantee, which brilliantly solves that whole collateral problem.
And just so you know, this isn't some small-scale niche idea. Look at this number right here. The Grameen Bank in Bangladesh, which was a real pioneer in this whole field of microcredit, had over 9 million members by 2018. That's 9 million people, the vast majority of them poor women, who finally got access to credit on fair terms. It's incredible.
The founder of that very bank, the Nobel Prize winner Professor Muhammad Yunus, put it perfectly. He said, and I'm quoting here, "If credit can be made available to the poor people on terms and conditions that are appropriate and reasonable, these millions of small people can add up to create the biggest development wonder." And that quote really brings us to the main takeaway of this whole explainer. Getting cheap, affordable, and accessible credit to everyone isn't just some nice-to-have thing. It's an absolutely crucial ingredient for a country's development, for its prosperity, for everything. Which leaves us with one last big question to chew on. If we know that credit is this essential for development, how do we design a system that makes sure it always helps and never harms the most vulnerable people in our society? That's the real challenge, isn't it? Thanks for joining me on The Explainer.